Ever wondered what exchange-traded funds, or ETFs, are all about? Well, you've landed in just the right place. ETFs are an integral part of the global financial market, and understanding them can be a game changer, especially for investors out there. They offer a unique blend of features that make them a compelling choice for many. We're about to embark on a fascinating journey, decoding the world of ETFs. By the end of this video, you'll have a clear understanding of what ETFs are and how they work. So, what exactly is an exchange-traded fund? Well, let's dive into that. Imagine going to the supermarket. Instead of buying individual ingredients for a salad, you buy a prepackaged salad mix. It contains a bit of everything: lettuce, tomatoes, cucumbers, and so on. An exchange-traded fund, or ETF for short, works in a similar way. It's like a prepackaged salad mix, but instead of vegetables, it contains a variety of assets. ETFs are a type of investment fund, an exchange-traded product. In other words, they are traded on stock exchanges just like individual stocks. But unlike individual stocks, when you buy an ETF, you're not buying a piece of one company. Instead, you're buying a basket of different assets. These could be stocks, bonds, or commodities. The goal of an ETF is to track the performance of a specific index. An index is a measurement of the value of a section of the stock market. It's calculated from the prices of selected stocks. Think of it as a barometer of the market's health. When you buy an ETF, you're essentially buying a slice of the entire index it's tracking. Let's take an example. Say there's an ETF that tracks the S&P 500 index. This ETF would hold shares of all 500 companies included in the index. When you buy a share of this ETF, you're essentially buying a small piece of all those 500 companies. The beauty of ETFs is that they allow you to invest in many different assets at once without having to buy each one individually. It's a convenient and cost-effective way to diversify your investment portfolio. But remember, just like any other investment, ETFs come with their own risks and rewards. It's important to understand these before you dive in. So, in essence, an ETF is a basket of different assets that you can buy or sell through a brokerage firm on a stock exchange. Now that we understand what an ETF is, let's discuss why they're so popular. One of the main reasons investors are drawn to exchange-traded funds, or ETFs, is the benefit of diversification. Think of it this way. Instead of putting all your eggs in one basket by investing in a single company, ETFs allow you to spread your investments across a broad range of companies. This way, if one company performs poorly, the impact on your overall portfolio is minimized. It's a way of spreading the risk, and it's a key strategy for long-term investment success. Secondly, ETFs are known for their lower costs. Traditional mutual funds often come with high management fees, which can eat into your returns over time. ETFs, on the other hand, are designed to simply track an index, sector, or commodity, which means they generally have lower management fees. This can make a significant difference in your investment returns over the long haul. Next, let's talk about liquidity. ETFs are traded on the stock exchange just like individual stocks. This means you can buy and sell ETFs throughout the trading day at market prices. This is a stark contrast to mutual funds, which can only be bought and sold at the end of the trading day at the net asset value price. This added liquidity gives you more flexibility to react to market conditions. Lastly, ETFs offer flexibility. They can be bought and sold like stocks, which means you can use advanced trading techniques like limit orders, stop-loss orders, and even trading on margin. This gives you a lot of control over your investment strategy. So, when you put it all together, it's easy to see why ETFs have become a favorite tool for many investors. They offer a way to gain broad market exposure while also providing cost savings, liquidity, and flexibility. This can potentially lead to better investment outcomes. With ETFs, you get the diversification of a mutual fund, but with the added benefits of lower costs and greater flexibility. Like any investment, ETFs come with their own set of risks. Let's delve into these risks to help you make informed decisions. Firstly, there's market risk. This is the risk that the entire market will decline, and with it, your ETF. It's a universal risk that all investors face, regardless of their chosen investment. If the economy takes a nosedive or a particular sector suffers, your ETF, which might be tracking a specific market index or sector, could suffer too. Secondly, we have liquidity risk. Now, ETFs are often praised for their liquidity. They can be bought and sold throughout the trading day, just like stocks. But remember, an ETF is only as liquid as its underlying assets. If those assets aren't readily tradable, you might find it difficult to buy or sell your ETF without impacting its price. This is particularly true for ETFs tracking niche markets or less popular sectors. Next up is tracking error. This is the difference between the performance of an ETF and the index it tracks. While ETFs aim to mimic the performance of a particular index, they don't always hit the mark due to various factors such as fund expenses and transaction costs. A high tracking error means the ETF isn't doing a good job at mirroring its index, which could impact your returns. And lastly, there's the risk of closure. If an ETF fails to attract enough investors, the fund may close down. If this happens, you might be forced to sell at an inopportune time, which could lead to losses. In conclusion, while ETFs are a popular investment choice due to their transparency, diversification, and flexibility, they are not immune to risks. Understanding these risks, market risk, liquidity risk, tracking error, and the risk of closure, is key to making informed investment decisions. While ETFs offer many benefits, it's crucial to understand the risks involved before investing. Remember, knowledge is power, especially when it comes to your hard-earned money. To wrap up, ETFs are a unique and versatile investment option. We've walked through the basics, breaking down what an exchange-traded fund is and how it functions. It's a type of security that tracks an index, sector, commodity, or other assets, but can be bought or sold on a stock exchange the same way a regular stock can. We've seen the many benefits of ETFs, like their high liquidity, the ability to buy just one share, tax efficiency, and the transparency of knowing exactly what assets are within the fund. They offer a simple way to diversify your portfolio across a broad array of investments, whether you're looking at stocks, bonds, commodities, or a mix. But, as with any investment, ETFs come with their share of risks. Market volatility can impact their value, and while they're generally more affordable than mutual funds, fees can still eat into your returns. The bottom line? ETFs can be a strong addition to your investment portfolio, but it's crucial to understand them fully before diving in. Research the ETFs you're considering, be aware of the associated fees, and make sure you're comfortable with the level of risk. Remember, understanding your investments is the key to making informed decisions. And now you're one step closer to understanding the world of ETFs.